everyone, welcome back to prestigious online classes. This is Economics Class 3. Today we're going to go over the Federal Reserve and monetary policy. The Federal Reserve System is the central bank system in the United States. In this video, we're going to go over what it does to influence the economy and how it can increase or decrease money supply to affect interest rates. We're going to go over open market operations, reserve requirements, and the money market graph. Contractionary monetary policy is going to slow down the economy. It is going to increase unemployment to combat inflation. Expansionary is going to do the opposite. It is going to cause inflation and less unemployment. When we talk about contractionary monetary policy, we're talking about selling bonds, increasing the discount rate, increasing the reserve ratio. And when we talk about expansionary monetary policy, we're talking about the opposite. Let's start with reviewing what exactly the Fed is. The central bank system is made up of 12 regional reserve member banks. This system has three functions: conducting the nation's monetary policy, providing and maintaining an effective and efficient payment system, and supervising and regulating banking operations. The Federal Open Market Committee, or FOMC for short, gets together to discuss the economic situation and decide on a course of action. Their dual mandate or purpose is to maximize employment and promote stable prices. The Fed has four tools to achieve its monetary policy goals: the discount rate, reserve requirement, open market operations, and interest on reserves. The last one, interest on reserves, doesn't come up as often as the other three, but it basically is the interest the Fed pays to banks for their reserves. If it's high, banks will be more inclined to put the money in the Federal Reserve's reserves rather than loan it out. Let's start with the discount rate. The discount rate is the interest rate banks are charged when borrowing directly from the Federal Reserve. When the Fed lowers the discount rate, the money supply is expanded. When the Fed raises the discount rate, the money supply is contracted. This is because there is more borrowing when the interest rate is low, meaning there will be an increase in excess reserves in commercial banks. So low discount rate leads to expansion. High discount rate leads to contraction. When it comes to borrowing, there is also the Fed funds rate. This is the interest rate banks charge each other overnight to meet the reserve requirements. It is lower than the discount rate to encourage borrowing from other banks and not the Fed. The reason we don't count this as a tool is because the Fed can't set a specific rate. The FOMC sets a target rate, but the actual rate that is used overnight can be higher or lower than that target rate that the Fed sets. The second tool we're going to go over is the reserve requirement. As the name suggests, this is the portion of deposits banks have to keep either in their vaults or in a deposit at the Federal Reserve Bank. Imagine the reserve requirement is 10%. Reserve ratio. Someone deposits $100 in any bank. That would mean they have to keep 10% of that $100 in their reserves rather than loaning it out. That would mean $10 in their reserves and $90 loaned out. When more money is loaned out, there's an expansion in the economy. It's a simple relationship. More money loaned out is it going to equal to expansion. So when the reserve requirement is lowered, so if this 10% is lower and the banks keep less money in their reserves, that means more money is going to be loaned out, which is expansionary. When the opposite happens, when the reserve ratio is increased, that means banks need to keep more money in their reserves rather than loaning it out, and that would be contractionary. So the relationship with reserve requirement is if the reserve ratio is increased, that's going to be contractionary, and if it's lowered, it's going to be expansionary. Lastly, we have open market operations. This term refers to the buying and selling of government bonds. The relationship is simple. Buying is going to be making the economy bigger, selling, making it smaller. You can remember it this way. Selling smaller, buying bigger. When the Fed buys bonds, they're paying those who sold it. This increases the money supply, promoting economic activity. When the Fed sells bonds, they're taking the money, lowering the money supply, which is going to slow down the economy. As long as you keep the selling smaller, buying bigger relationship in your head, it's going to be easy to answer these questions. To review, the Fed uses expansionary monetary policy to speed up the economy. It is usually done to combat recessions. The Fed buys government bonds to increase the supply of money, which increases inflation. This lowers unemployment. The goal with expansionary monetary policy is either to lower interest rates, which encourages loan activity and investment, thus increasing the money supply, or to directly affect the money supply by buying bonds. Contractionary monetary policy has the opposite effect. It is used to slow down the economy. This is usually done by selling government bonds to reduce the money supply, which lowers inflation. This, however, increases unemployment. The goal with this is to slow down the economy by increasing interest rates and lowering the money supply. This can be done through the selling of bonds or increasing the Fed funds rate or the reserve ratio to discourage loan activity. Now let's go over a model we can use to see the effects of monetary policy, the money market graph. This is very similar to the supply and demand graph. The differences are that the product we're talking about is going to be money, and the price is going to be the nominal interest rates. Our demand curve, instead of having a demand curve, is going to be money demanded, MD. And our supply is going to be vertical. That's going to be the money supply. So when the Federal Reserve increased the money supply, whether it is by buying bonds or the other things they can do to influence the money supply, there is going to be a shift to the right. And we can label this MS1. That's going to mean that with the same amount of demand for money, the interest rate, the nominal interest rate, is going to be lower, and the quantity of money is going to increase. If the opposite happens and the money supply is lowered, then the nominal interest rate is going to increase and the quantity of money is going to decrease. Now let's look at a couple examples. Let's say we have an expansionary monetary policy, and let's say that the tool that the Fed uses in this case is going to be open market operations. For open market operations to be expansionary, the Fed needs to buy bonds. Buy equals bigger. That's the way you can remember. Buy bonds. All right, let's draw the money market graph for this situation. Our vertical axis is going to be nominal interest rates. And in this case, nominal just means it's not indexed for inflation. Real interest rate would be indexed for inflation. Nominal would be just a raw number. Nominal interest rates. And our horizontal axis is going to be the quantity of money. In this case, we're talking dollars. Our demand curve is going to be downward sloping and labeled MD. And our supply is going to be vertical, labeled MS, standing for money supply. When we buy bonds, that means the Fed is paying money. And when the Fed pays money, it is putting that money out in the economy, which is going to increase the amount of money that is circulating, shifting the money supply right. MS1. So the interest rate prior was here. Let's label this 1 and label this 2 for making it easier. So that would be interest 1. And the second interest rate after the shift would be here. That means when we shifted the money supply right, the interest rate is lowered. When the interest rate is lowered, that means there's going to be more investment and loan activity because more people are going to want to get loans if the interest rate is lower. That is going to stimulate economic growth and grow the economy, speed up the economy. That is how you can see the effects of expansionary monetary policy on the graph. Now we have the opposite situation, contractionary monetary policy, and let's stick to open market operations. For open market operations to be contractionary, that means there needs to be a selling of bonds. In our money market graph, our vertical axis is going to be, again, nominal interest rate. And our horizontal axis is going to be quantity of money. Our demand curve is going to be downward sloping, money demanded, And our supply curve, let's label it MS1, is going to be vertical. When the Fed is selling the government bonds, that means they're getting paid. They're taking the money out of the economy, which is going to lower the money supply. MS2. Before this shift, the interest rate was here. And after this shift, the interest rate is here. And before this shift, the quantity of money was right here, and after this shift, it's here. That means the interest rate is increasing. When the interest rate is increasing, that's going to discourage investment and loan activity, which is going to slow down the economy. And when you look at the quantity of money, you see that the quantity of money is decreasing. That means because there is not much in the economy, it's going to be worth more, which means there is lower inflation. So that's the way you can look at this money market graph and see the effects of the money supply. When the money supply decreases, interest rates increase and inflation is lower. When the money supply increases, interest rates are lowered and the quantity of money increases, causing inflation. When it comes to shifts in the money market graph, the only thing that can shift the money supply is going to be monetary policy. And the things that can shift the demand curve are going to be inflation, real GDP, changes in technology, and changes in institutions. Lastly, we have another model, the loanable funds graph. The loanable funds graph shows the relationship between interest rates and the quantity of loanable funds. The supply of loanable funds is supplied by banks, and the demand is from businesses, individuals, and the government. As the interest rate rises, so does the supply of loanable funds. Conversely, the demand is lower when the interest rate is lower. Things that can shift supply include changes in saving behavior and changes in capital inflows. When people save more, they are depositing more money into the banks, increasing the amount that the banks can loan out. Things that can shift the demand include changes in perceived business opportunities and changes in government borrowing. For example, when the government is in a budget deficit, they will borrow more, shifting the demand to the right, which will increase interest rates. This is called the crowding out effect, and we will go more in depth into this concept in the video on fiscal policy. A related concept that you should remember is fractional reserve banking and the money multiplier. Fractional reserve banking is a system in where only a fraction of a bank's deposits are backed by actual cash on hand that is available for immediate withdrawal. Banks only hold a fraction of the money that are deposited into them as reserves. Keeping only a fraction of deposits on hand as reserves allows them to use the rest of the money not held in reserves as loans given out to other people. A bank will loan or invest its excess reserves in order to earn more interest. This money that is loaned or invested out is then used by other parties and deposited back into other banks, who then keep a fraction of that money on hand and loan out the rest. This process repeats over and over again. In effect, a $1 increase in the monetary base will cause the money supply to increase by more than $1. This can be measured by something called the money multiplier, the amount of money that banks generate with the money deposited into them. This concept is the basis of banks and explains the creation of money out of thin air. The formula for calculating the money multiplier, the maximum amount the money supplied could increase based on an increase in reserves with the banking system, is 1 over the reserve ratio. If your question is asking you to calculate the maximum change an increase in reserves is going to cause, then the formula you'll be using is change in money supply equals change in reserves times money multiplier. Alright, that's it for today. In the next lesson, we're going to go over fiscal policy and the models and concepts that go with it. Thanks for watching, and I'll see you guys in the next video.